ever doubt your judgment about trusting Madoff because Madoff made you feel like you were a genius too. He had that magic. It really is amazing.
The Bernie Madoff Ponzi scheme is one of the most notorious financial frauds in history. It spanned over 6 decades and caused losses of around $65 billion, making it the largest and most devastating Ponzi scheme ever uncovered. At its core, Madoff's fraudulent operations undermined the trust in financial institutions, exposed vulnerabilities in regulatory oversight, and left thousands of victims around the world in financial ruin. The case itself is a chilling reminder of how a mix of deceit, manipulation, and opportunism can exploit both individual investors and large institutions. This investigation delves into the history, mechanics, and aftermath of the Bernie Madoff Ponzi scheme, examining the strategies Madoff employed, the regulatory failures that allowed it to continue for so long, and the impact on both the victims and the financial industry. Bernard Lawrence Madoff was born in 1938 in Queens, New York. From humble beginnings, Madoff built a reputation in the finance world, eventually founding Bernard L. Madoff Investment Securities LLC in 1960. Initially, Madoff's firm was legitimate, focusing on market making, facilitating the buying and selling of securities. However, over time, Madoff's operation expanded into investment advisory services. It was in this arm of the business that Madoff began orchestrating the massive Ponzi scheme. Madoff's charm, business acumen, and perceived success drew in a range of investors, from wealthy individuals to charitable foundations and large institutional investors. His firm's returns were consistently high and remarkably steady, making it a highly attractive option for investors seeking consistent and risk-free profits. For decades, Madoff presented himself as an innovative financier with proprietary strategies and access to unique investment opportunities. His reputation among investors, both in the U.S. and abroad, grew to legendary status. A Ponzi scheme operates by paying returns to earlier investors using the capital of newer investors, rather than generating profits through legitimate investments. The scheme relies on a continuous influx of new money to meet the promised returns to earlier investors. Eventually, when the flow of new investments slows down or investors attempt to withdraw large sums of money, the entire operation collapses. Madoff's scheme followed this basic structure, but with sophistication and a long-term endurance that made it more difficult to detect. The key features of his fraud were consistent, high returns. Madoff promised and delivered annual returns averaging around 10 to 12%. Consistently year after year, even during market downturns. These returns were far higher than those available in legitimate markets, raising suspicions among some investors, but they were seen as part of Madoff's secret strategy, the split strike conversion strategy. Madoff claimed to use a strategy called split strike conversion, which involved buying blue-chip stocks, hedging with options, and balancing the portfolio to ensure stability in returns. The strategy was never verified because Madoff's firm never actually executed any trades in the way he described. Instead, he fabricated trade reports to convince clients that their money was being actively invested and generating returns. Secrecy and exclusivity. Madoff's firm created an aura of exclusivity, offering high returns to a limited number of select clients. This fostered trust among investors, many of whom believed that being a part of Madoff's inner circle was a privilege. In reality, Madoff relied on the reputation of his firm and clients' desire to invest with a well-known financier to perpetuate the scheme. Lack of transparency. Madoff's firm kept very little financial information accessible to investors, making it difficult to assess the actual health of the investments. Clients never saw real-time reports, and Madoff controlled all aspects of communication, making it hard for anyone to ask detailed questions about the nature of their investments. Feeding on the wealthy and institutions. Madoff targeted wealthy individuals, celebrities, hedge funds, and even institutional investors such as pension funds and charities. The sheer volume of funds involved helped to keep the illusion of profitability alive. The Madoff scheme lasted for decades due to a combination of factors, including Madoff's charisma, his ability to placate regulators, and the failure of financial watchdogs to detect the fraud. Regulatory oversight. One of the most glaring aspects of the Madoff case is the failure of regulatory bodies like the U.S. Securities and Exchange Commission (SEC) to uncover the fraud. Despite several warnings from whistleblowers, the SEC failed to investigate Madoff thoroughly. In 2004, Harry Markopoulos, a former securities industry professional, submitted a detailed report to the SEC outlining the suspicious nature of Madoff's operations. However, the SEC did not take action, dismissing the warnings and failing to pursue a proper investigation. Financial institutions as enablers. Several prominent financial institutions, such as Morgan Chase, had long-standing relationships with Madoff's firm. These institutions conducted minimal due diligence and failed to scrutinize Madoff's operations despite growing red flags. For instance, Madoff's banking relationship with Morgan was largely unexamined, despite the fact that Madoff's firm was handling billions of dollars without providing any clear evidence of real investments. The lack of auditing. Madoff's firm was one of the few large financial institutions that did not undergo regular audits by a major auditing firm. Instead, a small accounting firm, Freeling and Horowitz, conducted Madoff's audits. This firm was so small and understaffed that it was incapable of thoroughly auditing Madoff's operations. The lack of independent verification allowed Madoff to continue his scheme without interference. The unraveling of the Madoff Ponzi scheme began in 2008 when the global financial crisis forced many investors to request large withdrawals from Madoff's firm. The downturn in financial markets had eroded the value of many legitimate investments, but Madoff continued to promise returns. When clients began pulling out their money in larger quantities than expected, Madoff was unable to maintain the illusion of profitability. In December 2008, Madoff was arrested after his sons, Mark and Andrew, reported him to the authorities. The investigation revealed that Madoff had defrauded investors of nearly $65 billion, including principal and interest that had never existed. The SEC finally moved in, but too late to prevent the widespread damage caused by the fraud. Victims. Thousands of investors, both wealthy individuals and institutions, lost their life savings in the scheme. High-profile victims included celebrities, philanthropies, and large financial institutions. The financial impact was staggering, but the emotional toll on individuals who had trusted Madoff was immeasurable. Many lost their entire retirement savings and were left financially devastated. Legal and criminal consequences. Bernie Madoff was sentenced to 150 years in prison in 2009 after pleading guilty to 11 federal felonies, including securities fraud, wire fraud, and money laundering. He was ordered to forfeit $170 billion, an amount that represented the total principal and interest he owed to investors. Efforts to recover funds. The recovery of funds from the Madoff scheme has been a long and complex process. Irving Pickard, the court-appointed trustee responsible for liquidating Madoff's assets, managed to recover billions of dollars through lawsuits against Madoff's family, employees, and financial institutions that had been complicit in enabling the fraud. By 2024, approximately $14 billion had been returned to victims, but much of the remaining money was lost or irrecoverable. Regulatory changes. The Madoff scandal exposed significant gaps in financial regulations, leading to changes in how financial institutions are monitored and how investment schemes are scrutinized. The SEC and other regulators have since implemented more stringent measures to detect fraud, though some argued that lessons from the Madoff case still have not been fully learned. The Bernie Madoff Ponzi scheme was not just a failure of one man. but a systemic breakdown of regulatory oversight, institutional diligence, and investor due diligence. The ripple effects of Madoff's fraud continue to impact the financial industry, regulators, and individual investors. Madoff's deception was so successful because it exploited the psychology of greed, trust, and the allure of easy wealth. His downfall is a testament to the dangers of unchecked power, the importance of transparency in financial dealings, and the need for vigilant oversight in the financial sector.